Welcome back to CFI, Credit, Finance, and Investing. In today's video, we're going to take a high-level look at the credit requirements for buying a home. And in today's video, we're going to talk more about the government type loans, the Fannie Mae, Freddie Mac, and FHA. And before anyone goes off in the comments, when I say government, I'm talking about the government-sponsored entities, Fannie Mae and Freddie Mac, as well as the FHA program that allows people with lower credit score requirements and lower income sometimes, depending on certain guidelines, to qualify for a home. So jumping right in, let's talk about some of the things we're not going to talk about in today's video. We're not going to get into debt ratios or the amount of debt you can have in addition to your mortgage payment and still qualify for a loan. We're not going to talk about payment histories. We're not going to talk about any of the other nuances, appraisals, and inspections and things like that. This is specifically a short video about the credit requirements. So the first credit requirement, and actually let me preface this by saying this is mostly going to be driven by the manual underwriting process. And when you're talking about home loans, they're generally underwritten two ways. Of course, one is manual, and that's where an underwriter physically looks at the file and makes sure that all of the guidelines are met by the borrower or the person who is borrowing the money. The other type of a underwriting method is automated underwriting, or the desktop underwriter, specifically DU, that will go in and look at the loan qualifications or parameters that are input by a loan officer or an underwriter, and then they will approve it, meaning that the underwriter doesn't have to check if it meets all the guidelines per se, the underwriting guidelines. They only have to verify income information and asset information and property information. It makes it a much simpler process for a loan officer typically. So when we're looking at manually underwritten loans, there's a couple of different things someone will look at on the credit. They're going to look at the credit score and make sure that the credit score meets the guidelines, or if there's an exception to the credit score, they're going to have to make sure that it meets those exception parameters. They're going to look at how many trade lines or lines of credit that you have open, and we'll typically call those trade lines or credit lines. And then they'll also make sure that you don't have any significant delinquencies like the collections or tax liens or judgments or garnishments or anything like that that may show up on your credit report. Now, the specific garnishment that would show up on a credit report is going to be a child support lien that you would assume may have a garnishment attached to it. Some states will specifically allow the DSHS department to go out and when I say DSH, I'm talking about a Department of Social Health Services, someone who is in charge of child welfare. When a child support claim gets submitted to certain states' DSHS department, they'll go out and automatically garnish someone's bank account or garnish their wages. So we're getting into the weeds a little bit, so let's go back into the credit score requirements. So let me turn on my screen and I will show you. In this particular one, we're talking about minimum credit scores that are applicable to the Fannie Mae and Freddie Mac type loans. And it shows you here right under their minimum credit score, and you can see this is on the fanniemae.com website, their seller guide. And it talks about eligibility matrix, and a couple of those eligibility items are if you're getting a fixed rate loan, they require a minimum 620 credit score. If you're getting an adjustable rate loan, then you have to have a 640 credit score. Now, don't let the vernacular get too confusing here. It talks about fixed rate loans and ARMs. A fixed rate loan just means your rate is fixed for the entire term of the loan. The ARM is an adjustable rate mortgage, meaning the rate will float, and it may be fixed for 5 years or 3 years or only 1 year, depending on the product you get. It can go usually as long as 10 years floating before then it becomes adjustable. And those can be a great option for people who know they want to be in the home only a short period of time, but there is a level of risk associated with it. And that's why you'll see that the fixed rate loans have a lower credit score requirement than the adjustable rate loans. If you're looking at an FHA loan, then the minimum credit score there is 500, but be careful, there's a caveat. If you want to do the 3.5% down option, and that's one of the great things about an FHA loan is they allow a 3.5% down option, you do have to have a 580 or higher credit score for that program. If your credit score is between 500 and 579, the minimum down payment on that type of a loan is 10%. When we hop over into the types of trade lines, let's start with the credit scores also. The way that credit scores are calculated is there are 3 credit reporting agencies. There's Experian, Equifax, and TransUnion. And if you have 2 people or 2 borrowers applying for a loan, They used to take the lower middle credit score of each of the borrowers, and they've changed that recently to take the average median credit score of the borrowers. And what that means is, for example, if you have in the scenario borrower 1 and borrower 2, borrower 1 has a 590 low, 619 mid, and 648 high, and borrower 2 has a 661 low, 693 mid, and another 693 as their high, of course those being the same. They won't take the lower of the two, they will simply average these two, and in that scenario it comes up with a 656 credit score. So for pricing, for loan qualification purposes, this can be a significant gain, especially if you remember that the minimum credit score for this person to get a loan is 620. They would not have qualified before taking the lower middle credit score. Taking the median average, they do qualify for this loan. So a good move by the Fannie Mae Freddie Mac underwriting guidelines. If we move over to the trade lines, what trade lines would be required? Now keep in mind, if you're applying for a loan, and if your loan officer or underwriter runs it through DU and you don't meet these guidelines, but the desktop underwriting software approves your loan, you are not required to meet the guidelines that would be required for a manual underwriting loan. So that's kind of a cool thing. A lot of times we would see loans get approved that wouldn't meet the traditional guidelines because the desktop underwriter software found that it met their qualifications. However, if it does not, and if it has to get referred to an underwriter, this is what they're going to be looking for. They want to have at least one borrower whose income or assets are used for qualification. That means if you're on the loan and you're adding income to the loan or assets to the loan, they want to see these. They want to see at least 3 trade lines, whether or not on the credit report. Now, what does that mean? You'd think, well, if I have a trade line, it'd be on the credit report, and that's not necessarily true. There are some credit cards, there are some loans that they don't report to the credit agencies. Rent does not report generally to the credit agencies. So you can do non-traditional trade lines and have those added to your credit report as long as all of the other factors on your credit report are met, meaning the middle credit score requirements and the collections, judgments, charge-offs, things like that. It mentions here if the borrower does not have at least 3 trade lines and at least 4 non-credit payment references, or a total of 4 trade line or non-credit payment references, then you can go out and add potential additional trade lines. So these are some of the scenarios where that you could be used to add. So if someone is it talks about a borrower on the mortgage. So if you have a borrower on a mortgage, but they're not the primary borrower on that mortgage, it's possible that the credit reporting agency would not be getting payment histories for this person. The bank may only be reporting that trade line to the primary borrower's credit report, and that could then be added to this person's credit report. Now, your loan officer can walk you through how that would be done. It's not something you generally do, but they would have to make a call and have a credit company call and verify the payment history, and they will need some verification that you are paying that credit line. So if you are like a co-borrower on a mortgage, and you are making the payments for that mortgage, you can then have that added to your credit report manually. Here's another one. A trade line is owned by the borrower's spouse. So a lot of times spouses they'll commingle their funds and they'll both be paying the bill, or the one borrower will be paying and the other borrower may not be on the loan. If you can verify that you are making those payments, then you would again be eligible to have that added to your credit report. And one of the other requirements, of course, is that the borrower has been making the payments on that account for the past 12 months. So those are some of the criteria that they're looking for if they're adding alternative credit to your credit report. So something else to keep in mind on this is the addition of these items to your credit report in a standard manner will not impact your credit score, will not improve your credit score. You would have to somehow get the credit companies or the banks who hold the loans to report this to your credit bureau to be able to then to have it show up in your credit score. These items, when you're adding credit manually, are only for the verification to the underwriter that you have a good payment history, but because it would not be going through the credit scoring repositories or the Equifax, Experian, TransUnion's credit scoring system, it would not be improving your credit score. So cycling back up to here, when we're talking about the number of trade lines, the general rule of thumb when I was in the mortgage world and the finance world was we wanted to see 3 trade lines, and we wanted to have at least 1 year on each of those trade lines. So if you have 1 credit card and 1 student loan that is not currently in repayment, and that's all that you have on your credit, then that would not meet the 3 trade line requirements, especially if the student loan has not been in repayment. However, if you do have 1 credit card and 1 student loan that's been in repayment, meaning you've been making payments on it for at least the last 12 months, and you're missing that 3rd trade line, chances are, in my experience, you would have a credit score, and it would be a good credit score. And then to meet the 3rd trade line, you could verify that you had been paying rent on time for the past 12 months, and that would meet the 3 trade line requirements. So there are options, and make sure that when you're talking to your loan officer that you ask them, are you able to manually underwrite loans, or do you only use the DU approval? There are banks out there and there are loan companies that will not manually underwrite loans because there is an additional layer of risk to them when they try to sell the loan to Fannie Mae or have it guaranteed by Fannie Mae. Let's go ahead and move on to collection accounts, because this is also something that is very misunderstood in the credit world for people who are trying to get a home loan. Credit scores will impact, or credit collections, will impact your credit score. Collections, charge-offs, which is usually a collection that is not collectible and they just write it off, judgments, liens, things like that will all impact your credit score. But it's also important to understand which are going to be taken into account when you get a loan. So you'll notice here it talks about manually underwritten loans, and it says non-medical collections accounts and charge-offs on non-mortgage accounts do not have to be paid off at closing, which is something you won't hear if you ever get a call from a collector, if the balance on an individual account is less than $250 or the total of all accounts is less than $1,000. Non-medical collections and charge-offs and on non-mortgage accounts that exceed these limits must be paid off at close. So what this means is if you have a non-medical collection that is less than $250, or if you have several non-medical collections that total less than $1,000, they do not have to be paid off before you close the loan, or even at the close of the loan. If you have balances higher than that, then they will need to be paid off prior to the loan. And that doesn't mean you pay off down to $1,000 balance. That means you pay them all off if you have over that amount. So that's interesting. But it's also good to know that if your credit score is still high enough, meaning if you have that one non-medical collection, that one utility bill that happened to slip through 6 months before that you didn't know, and it's less than amount, you don't have to pay it off and you can still qualify for the loan. Something almost more interesting, though, to know is that it says non-medical collections. That means if you have medical collections, then you do not have to pay them off, even if they're more than that. The underwriting entities, the Fannie Mae's, Freddie Mac's, and even FHA understand that sometimes medical things happen, and if your credit is clean of everything except for some medical collections, you will not necessarily be required to pay those off to get a loan. Now, also keep in mind this is up to underwriter discretion, and if you have a whole lot of medical collections and it's over a whole bunch of years, that's different than if you have a one-time medical event that happens once and then everything else is clean. In my experience, your credit score will absolutely reflect that too. All right, now as far as medical collections, this goes a little bit further into that in the DU underwriting loan guidelines. It talks about medical collections and when they may be required to be paid off. So here it talks about medical collections are excluded from the limits below and are not required to be paid off in full or at closing. Now that is a great statement. If you are working on a loan and you have medical collections and the underwriter conditions, and that's what it's called when they say this is a condition of your loan. If they condition for you to pay off the medical collection, if that's the only item, you may want to write a letter back explaining why the medical collection should not need to be paid off and why it was a one-time event and it won't happen again and it's not reflective of how you pay your bills. But in the Fannie Mae guidelines, it does mention medical collections are excluded from the amounts below and are not required to be paid off. Now, in other instances, for one unit, that'd just be a single-family home that doesn't have multiple units. For one unit, primary residences or principal residences where you're planning on living for at least a year, the borrower is not required to pay off outstanding collections or non-mortgage charge-offs or charge-offs regardless of the amount. So if you've had a mortgage that went through a charge-off or a collection scenario or a foreclosure with an outstanding balance, that's when you'd typically see a charge-off. That may have to be paid off if there's a balance remaining. But for non-mortgage charge-offs, this guideline would apply. Now, this does give a little caveat here that if the lender marks the collection account to be paid by close in the loan application, the DU, and DU again is the automated underwriting system, will issue a message in the desktop underwriting findings report stating that the collection must be paid. So there is some discretion there that this must be paid off by closing. Now, it is a little bit more restrictive on 2 to 4 units. And that would be a duplex, triplex, or a fourplex, or a quadplex. They get called different things. But collections and non-mortgage charge-offs totaling more than $5,000 must be paid before you close. And then for investment properties, and investment properties typically carry a higher risk than a home someone lives in, individual collections and non-mortgage charge-off accounts equal to or greater than $250 and accounts in total more than $1,000 must be paid in full prior to close. So you'll see there's a big difference between the owner-occupied, or the one you plan on living in, at $5,000, or the investment property being a maximum of $1,000, because again, the associated risk to the lender is somewhat higher. So hopefully this gives you a little bit better feel for the credit requirements when you're looking at a home loan. A couple of things to address. Let's go back to the guidelines. A minimum typically 620 credit score for the higher loan to values if you're doing the Fannie Mae Freddie Mac, 580 credit score if you're doing FHA for the 3.5% down, so that'd be 96.5% loan to value deal. And then you'll want to have 3 minimum trade lines. You'll also, of course, want to have a rent history is typically helpful, but it's not always required. So 3 trade lines for a minimum of 1 year. And then if you are keeping your nose clean primarily on collections, you can qualify for the credit portion of a home loan. Stick around for other videos. We'll have more on the actual qualification guidelines. We'll talk about all things credit, finance, and investing. Hopefully this video has been helpful to you. If it has, please feel free to like down below, subscribe, make comments, or share with someone who may need it. Thanks for being here.